Good morning, everybody. Oh, it's 10:26. We're going to get started in about 4 minutes. All right, everybody, it is 10:30. We're going to get started. I'm sure there's more people trickling in. All right, so everybody, welcome to the Fundamentals of Financial Management, the SCORE workshop from SCORE Akron. So we are going to have access. You guys will be able to type questions in the chat or in the Q&A, or you can even raise your hand. And I'll monitor those as we go through, so you can get all your questions answered. And after this workshop, you will get an email with the slides and also a link to the video of this. This is being recorded and it will be on our website. And with that, we can get started.
All right. Thank you, Laura. Well, first of all, welcome to all the attendees for joining us to attend Fundamentals of Financial Management. For some people, finance is like another foreign language. So I hope that by attending today, I can explain some of the concepts to you. But I will say that following this, you should keep learning. Because as a foreign language, you need to keep adding to your vocabulary and your knowledge. So thank you for joining us today. So little background, my name is Madhu Dewan. I have been a SCORE mentor for 7 years. And I've assisted many SCORE clients in developing business and financial plans. And I'm a retired guy from Bridgetown with a background in finance and engineering. And again, assisting me is Laura Sender, who will help me manage the questions and inquiries that you have. For those who are not familiar with SCORE, SCORE is a nation-based nonprofit, and our mission is to foster small business communities through mentoring and education. I and my fellow mentors believe that small businesses are a key for economic growth in our area. So we do spend our time and effort and expertise in providing any support that is needed for a small business owner. So this is today a live workshop, but I also urge you to consider mentoring from SCORE, which we do on a one-to-one basis. And you can contact SCORE on the website, or you can call our office, and based on your zip code, they will match you up with a mentor, a SCORE mentor. On the website, you also now have the option to review the mentors that are available for their expertise and choose your own mentor. So again, and I do take advantage of SCORE's mentoring opportunities. In addition to workshops and mentoring, many of the webinars that we do are recorded. So there's a list of nearly 300 webinars that you can go on this website and choose the topic that you want to learn something about. And the good thing about this is you can do that at your own time, own convenience. Most of these webinars are given by mentors like me. They take anywhere from 45 minutes to an hour. But I will assure you that taking the webinar, you will learn subjects from people who have good practical experience. Your biggest challenge may be to finding the right webinar. So be patient in searching for them, because there's a lot of webinars that they have on there. So look through them and see what, and they have them organized by marketing, strategy and planning, business plans, operations, technology, accounting and cash flow, human resources, tax planning, customer relations. So again, all the business topics that are necessary for the business. So with that, I will share the agenda for you. I have a 4-part presentation. And the first part is building the financial plan. Then we'll talk about bookkeeping. We'll also talk about financial statements. And we'll also talk about comparison of actual to forecasts on financial statements. At this point, I would just like a couple of volunteers in the audience to raise their hand and then tell us what is it they're looking for in the workshop today. And hopefully, as I go through my discussion, I can try to answer that. Also, tell me what kind of a business you're thinking of starting or you're in, so I get a feel for the audience. So I'm gonna give a couple of minutes for you to raise your hand and volunteer as to what you want to learn from the seminar today. Laura?
All right, everybody, go ahead and hit the raise hand, and I'll unlock so you can speak. All right, I got one. Okay, Yvonne, go ahead.
Hi, can you hear me?
Yes.
I can.
Okay. So we actually own 2 different businesses. One is a custom embroidery, and then the other one is a trucking business. We have a fleet of trucks, small fleet of trucks.
Mhm.
So for our trucking business, we started in 2017, and I was just using an Excel spreadsheet for incoming expenses and income.
Mhm.
We now have to, as of last year, we are switched to an S Corp. So now I have to use QuickBooks Online, and I know nothing about that. So I'm just wanting to learn more about bookkeeping, how to keep things organized for the 2 businesses, and just the basics, I guess, for that. And what
Okay.
we would need like at tax time or whatever.
Okay. Well, Yuan, you're already doing the right thing by working with Excel, and later on I will talk about software that you can use. And again, just to be clear, I believe SCORE offers a seminar on QuickBooks. Okay, all right.
Oh, okay.
So again, I'll give you some information today, but QuickBooks usually, and I have some thoughts on QuickBooks that I will pass along to you, and some resources on QuickBooks. Okay.
Okay,
So
thank you.
get you, so your time will not be completely be wasted. Okay.
Okay, thank you.
Okay. All right. Anybody else wanting to volunteer what they're expecting to learn?
All right, anybody else? Feel free, it's helpful for us. Nobody else is raising their hand.
All right. So again, like I said, you guys can interrupt me anytime during my presentation, and periodically I'll stop myself and ask Laura for the questions. So again, it's something on your mind, do bring it up. This is I'm not blaming anything, but I do want you to learn by the time the seminar is over. So please be aware of that. Okay, so we're going to go with the first part of the presentation, which is building the financial plan. And so just a little discussion on business plans and financial plans. A business plan, this meeting today is not about business plans, but a business plan is a document that talks about the structure of the company, products and services, marketing, how you manage the company, if you have inventory, how you manage that, what taxes, insurance apply. And then one part of the business plan also deals with finances. So that's the financial plan. So in a way, a financial plan is part of the overall business plan, okay? And it converts information that's in the business plan to dollars, okay? And you end up estimating net income and cash flow over time. And if there are any loans to be paid off, you talk about them, how they're paid off, okay? So it is appropriate for a startup business or existing business to write up a financial plan. Okay, so that's the idea there. Okay, now to develop a financial plan, like I said, we convert all the ideas you have into numbers. So going from left to right, what's the cost of your product? We'll include in the financial plan how you operate the business, what's your sales going to be, how you're going to market your business, and then what is the money needed in terms from your own investment and your loans, and is the business generating enough income to pay these loans? Okay, so again, don't jump into a financial plan right away. Try to assess some of these things in the business plan, so then when you do a financial plan, you have the data to develop a financial plan. All right. So again, who needs a financial plan? Anybody starting a new business, so you understand how much sales and profits are for next 5 years. Many of you will be applying for a bank loan, and a bank loan and a bank will request a financial plan, so they can see that you can pay their loan off. Okay, if you have partners in a business plan allows discussion on what the expectations are of the business, because you can just say, hey, our business will do real well. Okay, I mean that really could mean different things to different people. Okay, but with a financial plan, you can say, okay, our income will be $100,000 this year, and we will share 50-50, half of that. That is a more concrete understanding. It's $50,000. It's not $500. It's not $1 million. So it's a clear understanding between partners. Okay. And again, if you're expanding an existing business, you can also see if that makes sense when you apply for a loan. If you are a not-for-profit business, you should still do a financial plan so that you can apply for grants and do your annual 990 filings with the IRS. So again, everybody should look at doing a financial plan. Now, why have a financial plan? You know, small businesses are a pretty dynamic part of our US economy. We have nearly 627,000 people starting new businesses every year, and unfortunately, 95% fail. And when people do surveys to find out what went wrong, we find these 5 reasons why many businesses fail. So some relate to lack understanding of cash flow. Some people start with too little money and then they run out as they have initial losses. Some people price their products too low. They're not covering all their costs. People are over optimistic about sales. They're not seeking help. So if you do a financial plan, at least the first 3 reasons on this list, cash flow understanding, how much money you need to start, and what your appropriate pricing should be, I think should be clear to you. So at least you are taking 3 of the 5 reasons why business fails. Okay, so I would urge you to consider doing a financial plan. All right. So now I'm going to give you an example of a financial plan of an existing business that is trying to expand, and I'll discuss that in detail. But again, before you do a financial plan, you should estimate what the total investment is required for you open the doors for, you know, either buying property or renting property or modifying the property. And then most new businesses have losses initial years. You should be able to cover that. And also, you should have some contingency, about 10 to 20%, so you don't run out of cash, okay? Now, you may put the money in the business, or you may keep this money aside and use it only if you run into trouble. But remember that as you launch your business, you should make appropriate plan to make sure you have enough money to cover yourself in case things don't go as you expected or forecasted, okay? The next step is source of funds. You know, where does money come from? And in many cases, you have to have an owner investment, about 10 to 20%. You look for a bank loan for a profit business. And if you're for a nonprofit business, you could also look at a grant, okay? Generally speaking, grants are very few and far between for for-profit businesses. That has been my experience. And for nonprofits, you can qualify for a grant. So, you know, keep that in mind, okay? So I told you I'll show you an example of a business plan. And actually, this is a real case example in a person who was looking for a loan. This person had the company was New Restaurant LLC, and they were located in Stowe. And really, they had been doing reasonably well in Stowe, but they wanted to expand with a food truck, and then perhaps look at another restaurant in Green, where they had their eye on a property that is available to them for just paying taxes. You know, it was one of these old buildings, and they were looking at that. And as they were looking at their business plan, they also wanted to update their restaurant in Stowe. Okay, so as we discussed this, they needed $102,000 to carry out their plan, which was to buy a food truck, update their facilities in Stowe, and create a new restaurant in Green. Okay, so they looked at $102,000 in their financial plan. They were going to put up $10,000 of their own money, and they were looking for a loan for $92,000 for 10 years. Okay, and the question to them was, for them was, can loan be paid off, and how much money will they be making? Okay, so this is the situation, and I think you guys may be in a similar situation. So again, the first step they did was they estimated what they need to do the business. Okay, so for the food truck, they were looking at buying a used food truck with $30,000 and then modifying it to $15,000. For the Green location, they needed the fryers, freezers, chairs and tables, modifications, signage. We're looking at $31,000 for the Green location. And then for the Stowe location, they needed some new furniture of $16,000. And then they needed about $10,000 in working capital, because they were going to hire staff for the food truck and also for their Green location before, the money started rolling in. So again, their grand total investment was $102,000, and that's what we're trying to develop their business plan for, which they were ultimately going to take to a bank. Okay. All right. So a lot of numbers here. Let me make sure that I could. Okay. So hold on a second. Let's. I'm trying to get rid of this bar here, guys. Okay. All right. So the plan was to start this project in July of 23. Okay. And one thing I'll mention to you that if you're looking for a bank loan, make sure you give yourself 2 to 3 months to get money from a bank. Okay. Banks take time in approving your loan. Okay. So starting in July of 23, and again, this company is called New Restaurant LLC, and I will show you some data in the second half of 2023. Okay. So starting in July, they put their own money, $10,000. And so you start off at $10,000 in their business account. And then next month in August, they start with $10,000. They had $5,000 of sales in their store restaurant, and the loan was approved, so they have $97,000. So now they had cash available, $107,000 in the beginning of August, so they can do their project. Okay. So the month of August, they had many expenses like buying food, paying their employees, repairs and maintenance, advertising, paying rent in store because they were renting that place there, telephone, utilities, and insurance. Again, this is the amount of money they were spending. And then they started using their loan to update their store location in over 2 months. And so by the end of August, they had spent $10,000, and they still had $96,000, $225 in their checking account. Okay. Again, that carries over next month in September. And again, they have sales. Again, there are no more loans. They're spending money. But that month, their plan was to buy the used food truck and also complete renovations to their store place. So they spent $45,000. And now their checking account ending position is $55,000, $593. Okay. So next month, as they modified their place, their sales increased in Stowe, and their food truck, they could go out and go to some events and use their food truck for additional sales. So now their sales have gone up, and now all these expenses they're paying. But again, they are still renovating. Now they're renovating their space in Stowe, and also, well, I just finished with Stowe. Okay. And again, they have got the loan now, so they're paying interest here. Where are the interests? They're paying about $634 in interest, and they are also, making payments on their principal, and also having an owner's draw. So all these cash flow items, they are tracking, and now their checking account falls to $40,000, $567. Okay, so we keep doing these calculations. And we project at the end of December, we have $8,733 in that month. Okay, so again, this year, let me just move this second here. So in 2023, they had total sales of $32,500. Okay, and they have now used up all their loan money to do the things that they wanted to do in various places. Okay, so this was the first half of the year. Okay, we did a second here. Okay, next year we did this for 2024 by month again, and the reason I do at least the first year or the first year and a half by month, because I want to make sure that you don't run out of money on a monthly basis. Okay, so again, now we are forecasting sales for the 3 locations: the store location, the food truck, and also, which only works in spring, summer, and fall. And now you're having some small sales in green. So again, your sales are increasing, so are your expenses. But at this point in time, all the investments that we have made, our checking account, our money on hand, starting at 8,733, keeps declining all the way through July, okay? But then sales pick up and our profits get better, and then our checking account balance keeps increasing, and by the end of the year, we are at $10,000. So we have a little bit of a room. I myself was concerned at these low checking account balances in this time frame, but this client said that, you know, they assured me that they had other funds that they're in trouble. But again, that was their plan. Okay. But again, you don't want to go negative. You don't want to go too low, because that means you can't pay your employees, you can't buy supplies, and that's not a good thing. Okay. All right. So this was the first 2 years, and then I helped them. Hold on a second. Help them summarize all this on a yearly basis. So 2023, 2024, we did by month. I just added that. But then we forecast this for 2025 and 2026. Okay. So, you know, like I showed you that their sales are about $36,000. No, excuse me. Well, how much were their sales? The sales were $32,500 in 2023, and they opened a food truck in other locations. Their sales kept increasing every year. Okay. All right. And their loan balance, which was $92,000, they kept paying the loan off, and that kept declining each year. So again, by the end of 2026, they only owed $42,000. And their checking account, or the cash on hand, also improved as they went out in the future years. Okay. So again, this is a financial picture. And by the way, all this time they're paying their loan, they're paying their interest, and they have been able to use the loan to modify their business. Okay. And so again, you know, there's a lot of numbers here, but again, you try to forecast as to how things will go on, so the bank is assured that they are generating enough cash to pay the loans off and also be in business. Okay. So again, I will stop here and ask you if you have any questions. Again, this is a cash flow basis that I will helping them do, so they can see what's going on. Okay. So I'm going to stop and see if any of you have any questions.
Okay, so Olivia posted something right as you were starting this section. It says 10 to 20% of what? Total investment or certain months overhead?
Okay, I'll answer that. Okay. So I would say 10% of your initial investment. Okay, that's what you should have. And like I said, you know, 10% you have to put in the business, because otherwise you won't get a loan. Okay. If you can put another 10%, it stays there even if you don't need it, but it's like a cushion. Okay. But some people will say, okay, I have the money, but I will just put 10% and keep it aside in case my souls don't pan out. So 10 to 20% would be of the initial, I will say, initial project cost. In this case, it's $102,000.
Okay, the other question is from Rebecca. She joined the call late.
Mhm.
I don't know if this is something you want to do now or later, but her question is, what are key financial management considerations for a consulting company?
For a consulting company. Okay. So I have helped consulting companies. I mean, people start a business where they were working, and then they become consultants. So first of all, it takes a while for the consulting business to pick up. Let's say you were working someplace and you're making $100,000, okay, a year. Obviously, your consulting fees won't be $100,000 right away, okay? So some considerations that I tell them is to, number one, work out of their home, use their existing assets. but very important, have anywhere from, I will say, 6 months, 6 months of money, so that as your business builds, you still have money to pay your rent, pay for your car, pay for your food, okay? So the key consideration for a consulting business is that you should start with money, so that as your business grows, you're able to live that lean period, as I would call it, okay? Now, in case of a consulting business, it is difficult to get a loan, okay? Because you can't show any hard assets to a bank. I'm not buying a truck, or I'm not buying a car. So it is difficult to get a loan, okay? So for consulting, the key consideration, I would say, is that you should have enough money to survive your expected lean period, okay? So what typically happens is you start from zero in consulting, you increase over 6 months, and then by the end of the year, maybe you are able to replace your existing, say, income or something, okay? Did that help you?
I'll wait a second for her to answer.
Okay.
She says, yes, thank you.
Yeah, no, so for consulting, it's very important to have a cushion, much more than, because you're not generating your cash quickly, okay? All right, so so this was a business plan. Again, there's a lot of numbers. Again, and this template is available at SCORE, and many of our mentors can help you work your way through that, okay? All right. Why clients don't do a financial plan? And this is from my experience. I think many of us, including my clients and myself, we have difficulty forecasting or estimating the future. And what I tell you is, do some research and estimating. If you have a business, you have some actual experience. If everything else, and again, I understand the problem. Okay? Guess, okay? And I will say to you that inaccurate estimates are better than no estimates, okay? Try to be as realistic as possible, but don't let put numbers down on papers on sales and all that, okay? And then if you have some experience, how much it costs, you should be able to do a plan, okay? A lot of people are not comfortable with numbers, okay? And I will say that get comfortable with practice. Look at your personal checking account each month. Look at your statement each month. Kind of take that data and work it on a spreadsheet to see, how the money came in and which all places you spent it, and that way kind of makes you more comfortable dealing with numbers. I also urge people to learn spreadsheet software like Excel numbers or Google Sheets. Again, Google Sheets, if you have a Google email, is available to you free. And again, delve into it, learn about it, set up a simple model, so you become more familiar with numbers, okay? The other thing I'll tell you is that the financial plan that I showed you, I know one thing for sure, it won't work out exactly the way it was laid out there. So a financial plan is more like a compass. It tells you directly which way you're going, okay? It's not like a GPS. So don't get hung up on every little detail, okay? Try to be complete instead of trying to be very detailed, okay? And you'll be directionally correct. And really, as we get into your business, as you get new information, you can always update it. Remember, this is your plan. And as you get more information, you can update it and take corrective action. So again, that's why I urge my clients to do a financial plan. Okay, so that was a financial plan for starting a business or expanding your business. As you are in business, you will do bookkeeping. And here are some of you are all in business, you already know all this, but what is bookkeeping? Bookkeeping is the critical component of tracking all your income and expenses in an organized manner, okay? And there are some tips that I have on the next page that allow you to do this in an organized manner, okay? If you do this haphazardly, your personal accounts and your business accounts will be all mixed up, and you'll have difficulty understanding if your business is making any money, and more importantly, when you have to pay taxes, how much money you can withdraw. You'll still be struggling if you don't have a good way of bookkeeping, okay? So some things that I suggest, call this my 10 basic steps. And again, start with paper or spreadsheet, and then later obtain business software as business grows, okay? One thing you must definitely do is open a separate business checking account. And each month, you look at your statement and see how the money came in and how the money went out, and save these statements on your computer, so you can use them for analysis and also filing your taxes. Track sales, deposit all sales. If you get cash sales at a fair or something, instead of just putting it in your purse and or a wallet and just start using it, try to deposit that in your checking account, okay? And if you buy supplies for your business, be disciplined to either write checks or use business credit card, so everything is getting recorded in that account, okay? And of course, pay business expenses first. And if you have to withdraw money for your personal needs, I will say you take your owner's draw once a month or twice a month on specific dates, and also a fixed amount if the money is available. That way you know how much money, and again, you can take that owner's draw and put it in your personal checking account, but then your business knows where that money went, okay? Some of my clients, they take the draw many times during a month, and really, they're not sure what's going on in their business, okay? And really, at the end of the month, look at your cash flow, see how much money you have in a checking account. Is it more or less than last month? Hopefully it's more. If it's less, then see what has to happen for you not to get negative the next month. So those are the kind of things you have to do in bookkeeping as you do that, okay? Okay. Like I said, at some point in time, you should get financial software, and I think I have listed some names of some software at the end there. But again, hopefully, if you have done this on Excel sheet or done it on paper, you kind of understand how the money is coming in and going, okay? The financial software requires you to set up accounts, okay? And many people find that very intimidating. But if they have done the thing by hand, then they're in a better position to set up their accounts, okay? And again, a software allows you to keep track of your business and see what's going on, as many of the activities are now automated, okay? So again, start doing it manually. As transactions grow, go to a software, okay? All right. So assuming you have a software, and now we'll talk about financial statements and can explain to you what they mean, so you can use them to analyze your business and improve your business, okay? So the three statements that we talk about, one is the cash flow statement, one is the income statement, and one is the balance sheet, okay? So I'll go through all these three and tell you what they mean and how you use them. And so you're able, when you generate these statements, to be able to understand what they're telling you, okay? Okay. A cash flow statement, by the way, the financial plan I showed you was a cash flow statement, but again, it's for a specific time. It's for a month or a quarter or a year, okay? It's for a period, okay? And the best way to understand cash flow is money coming into your business, whether it's cash sales or your contribution or loans, or you have receivables and money comes in sometime later after you have made your sale. So all that is money coming in, okay? And cash outflows are what you purchase, whether they're assets, inventory, expenses, loan payments, or owner withdrawal. So very simply put, you have a beginning cash balance, and I would say that's like your starting checking account at the beginning of the month, what money came in that month, what money went out that month, and it should match up with what you end up on your checking account that month. Okay, this is cash flow for a period. Okay, so I'll use an example again, a simplified example to show you. Let's say you have a pet care business, and cash on hand in your checking account is $5,000, and that month you had cash sales of $10,000. You collected receivables of $15,000, so total receipts are $25,000. And then that month you paid out things like purchases of inventory, salaries and benefit, taxes, other expenses, loan payments. So you paid out $23,000. So that month, your cash coming in was $2,000 more than what you spent out. So your checking account should be at $7,000. Now the $7,000 gets carried over to the next month, February. And again, that month, we have sales, we have receivables, we bring in $26,000, then we spend out $19,500 that month. So your increase in cash is $6,500, and your checking account balance should be $13,500. Okay. The thing with cash flow is that you should have enough cash in your checking account and your business to pay your bills as they come due. Okay. So if you have employees, if you pay them every Friday, you should be able to meet your payroll every Friday. If you don't have cash to meet that payroll, it is very unlikely that your employees will show up to work the following Monday. Okay. So that's why we say out of cash means out of business. Okay. So on a day-to-day basis, on a week-to-week basis, you must ensure that your business checking account has cash to meet the obligations that you have to meet, whether it's for supplies or for paying your employees. The only element that you can control is your owner's draw. Okay, if your business is not making enough cash, you can make a decision to say, okay, this month I will struggle and I will not take owner's draw. I will use my savings to pay my bills. Okay, but everything else in business you have to pay, and as you go through the month. Okay. All right, so that was cash flow, and sometimes income statement, cash flow, people confuse them, but they're two different things. And I will tell you, there's some items that are cash flow items that are not income items. There's some items that are income and not cash flow items. So you need a little experience to figure out what is what. Okay, and again, if you have any questions, you can ask a SOAR mentor or Google it. Okay. So in case of a income statement, this is also for a period, a month or a quarter. And again, I'll show you an example where it shows sales. And the cost of goods sold means the sales that you accomplished, what was the cost of the goods that you sold, okay? So an example would be that if you sold 10 shirts at $20 each, that's $200. Really, the cost of goods, which should be, if it's $5, then that's what should go on this line, okay? And sales minus cost of goods sold is your gross profit. On top of that, you have operational expenses like insurance and interest and things like that. You also have taxes. And after all that, you have net income or loss. So here's an example of an income statement. Again, the pet care company for the month of January. They had sales of $18,000. And to accomplish these sales, because they're selling some pet supplies and things like that, pet foods, the cost to acquire those supplies was $7,000. So their gross profit is $11,000. And we always divide the gross profit from the sales to get gross profit margin, 61%. We always do that to make sure that this is a positive number and see on a month-to-month basis how that is changing, okay? And if it's changing in a negative way, we need to understand why that is happening, okay? In that month, your salaries, benefits were $3,000, utilities $500, you spent $1,000 on advertising, $500 insurance, $1,500 rent, so you spent $6,500, what we call operating expenses. So gross profit less operating expenses, that is your profit before taxes, okay? That's $4,500, okay? So again, in this case, these 2 months are independent. That's not like cash flow where the cash carries over, okay? So in February, we see that we had sales of 20,000 and we had gross profit, cost of goods of 6,750 because we had higher sales, and our gross profit minus 62%. Again, we had a lot of, not a lot, but operating expenses. And this month we made $6,200, okay? So the question people often ask is, what is the difference? Well, anyway, I'll talk in a minute. Let me see if I have that next or, yeah, okay. So before I go to balance sheet, so the question is, what is the difference, okay? And why do you use different things, okay? So to answer your question best, cash flow tells, number one, you need to keep track of both, okay? Cash flow and income statement, okay? So cash flow tells you that you are running your business on a day-to-day basis and you're using the cash to cover your obligations. Income statement is a little different. It tells you that if your pricing and costs, let me get rid of this. Oh, a second. If your pricing and costs are appropriate, okay. If your income statement is showing a loss, it's a pretty good indication that your pricing and costs are not appropriate, okay. And sooner or later, you'll run out of cash, okay. So this is a good way, because your cash flow statement is not telling you, whether your pricing is right or wrong. But if you're creating a loss every month, that means your revenue is not covering your costs, and you're not going to be able to survive, okay? Some examples, like a loan repayment, usually includes principal and interest. Principal is a cash flow item because you have to pay the bank, but you're not allowed to use it as an income statement item because you're not allowed to use that as reduction against your taxes, okay? Because you borrowed that money, you're returning money, so it has no income statement effect, okay? Now, interest is both a cash flow and an income statement item, because interest you're paying to a bank, so it's a cash flow item, and the IRS regulations allow you to deduct interest as a deduction on your income tax, okay? So again, some items are cash flow, some items are not, and some items are both, okay? Sometimes in your business, every 6 months or so, if you have cash, you may decide to declare a dividend, which means that you return the money back to the owner. And again, this is a cash flow item because you're taking money out of the business, but it's not an income item. This is really paid after taxes, okay? So so keep that in mind, okay? All right. The last financial statement that we need to talk about is the balance sheet. And again, the best way, again, the balance sheet as opposed to a cash flow or an income statement is a point in time. And the example I'm using here is on specific point, end of the year 2017. And it tells you what the cash position of your business is at some point in time, okay? So like assets are what the business owns that have value, okay? And some things, typical things that businesses own is their checking account. If customers owe them money, that's receivables. That has value. Inventory that they have is value. If they have equipment like a car or a plant, that has value. If they have a building, that has value. So all these are listed on the asset side of the balance sheet. And then on the other side is what we call liabilities, what the business owes, okay? If we have to pay our suppliers, those are called payables. If we got a debt, we have to pay the bank back. So those are liabilities, okay? And then this equation always must hold true. Assets, what you have own of value, is either you create a liability like a loan, or you put your money yourself itself, okay? So Owner's equity is what is your interest in that business at that point in time, okay? So an example I sometimes use with people is if you own a house, that's worth $100,000. And if you had a loan of $80,000, that's your liability. And $20,000 is the value that belongs to you, that is you, okay? So if you sold that house, paid the loan off, you would get $20,000 left with you of your business. One way to think of owner's equity in a business is typically that's the value that you have in the business that you could perhaps look at selling the business for, okay? And if it's negative, that's not a good sign, meaning that your liabilities are more than your assets. So really, you're on the whole regarding value when you need to do something to make it a positive earning business, okay? Businesses that have negative value end up declaring bankruptcy or going out of business, okay? So again, we look at these balance sheets not as frequently as cash flow or income statement, but once a quarter, we need to look at that to see how we are changing from point to point. Again, this is an example. As of January 31st, this business has cash of $10,000, accounts receivable of $15,000, inventory of $5,000. So they have $30,000 what we call current assets, okay? They also have some equipment worth $18,000. It has depreciated $8,000. So they have long-term assets of $10,000. So this business has $40,000 in assets, okay? Liabilities, accounts, they owe money, $10,000 to their suppliers. Their current loan is $3,000, and their long-term bank loan is $15,000. So their liability is $28,000. So the way to think of it is they owe things of value $40,000. They owe $28,000. So this business on this date has a value of $12,000 for the owners, okay? So liability plus owner's equity equals assets, okay? So those are the three statements that typically you will use in a business. And again, I will stop to see if there are any questions that I can answer. Laura?
Okay, everybody, type in your questions or raise your hand. Right now, there's no questions, but let's wait a few seconds. Nobody's typed any questions.
All right, I'll keep going. Again, like I said, you can type your questions anytime you want, okay? Okay, so the last piece on the agenda is comparing actual to forecast, okay? We have talked about financial statements, and as your business becomes a little bit mature, what we also suggest is what we call comparison of actual to forecast, okay? So what does that mean, and how does that help our business, okay? So what we suggest is that for income and cash flow statement, we should make a forecast, at least on a monthly or quarterly basis. And as you saw in my financial plan earlier, I had made a forecast by month for the first year, okay? For balance sheet, you should make a forecast of where you expect to be on a quarterly or annual basis, okay? So if you do this ahead of time, then when that month or that period is over, then you have information to compare what you expected to accomplish and what you actually accomplished, okay? So you use comparison of forecast to actual results to see how you perform versus what you were thinking, okay? Now, it'll be different, that's for sure, okay? It could be better, it could be worse, okay? But the point is, are you kind of moving along what you were expecting in the business? And it also could mean that some of your assumptions of the business could be wrong, so you need to take corrective actions, okay? So we see what the weakness is, what the strength is, and then we can see pinpoint areas where we have leakage of sales. For example, our unit volume is less than what we thought. or the pricing that we realized was less than what we thought, okay? Our product cost is more than what we thought. Our operating expenses are different than what we thought. So in the end of the day, our profits will be different. But now we know what is causing that difference. Is it the revenue side of things? Is it the cost side of things? Because we need to know that if our profits are different, where as business owners, we should take action. Okay. So I can show you an example of comparison. Yeah. So, okay. So this is January from some year, and we are looking at the forecast that we had made before January. And then when our actual numbers came out, this is what it looks like, okay? It turns out that we had forecasted sales of $20,000, but when the actual numbers happened, we only sold $18,000. And we had expected our cost of goods sold to be $6,000. It turned out to be $7,000. So really our gross profit, which was expected to be $14,000, only turned out $11,000, okay? As a percent, it was, instead of 70, it was 61%, okay? Then we go to the expenses side of things, and we see that we spent, we expecting to spend $2,500 on salaries and benefits. We spent $3,000. Utilities were more. We controlled expenses by spending less on advertising, $1,000 instead of $1,500. Insurance was fixed, rent was fixed, okay? So in this case, our total expenses, we forecasted to be $6,400. It turned out to be $6,500, okay? So now, our profit that had expected to be $7,600 turned out to be $4,500. Okay, when you look at this comparison, the question is, where do we need to focus our efforts to make sure that our profits are what we expected it to be, okay? And in this analysis, I will say that our costs are okay. I mean, individual lines are off one way or the other. But again, we were pretty close, within $100, okay? But our major problem for that month was on our sales side, okay? Because we didn't accomplish the sales, and there could be reasons for that. And the materials that we bought were more, okay? So you as a business owner have to think that, okay, if I need to get back to my plan, I need to take actions on the sales side, okay? If your unit volume was low, you may consider additional advertising. You may consider going to additional places where you can make your sales. And then if your cost of acquiring goods is more, I think you need to look at different suppliers, okay? Actually, I should take it back. You don't have problem with expenses. You may have a problem with your cost of goods sold because the suppliers, charge you more than what you're expecting. So you need to look at how you source your product, okay? So again, forecast versus actual should always be done so that you can take corrective action to make sure that your business is giving appropriate returns so that you can use, first of all, to pay your loans, to support yourself. So that's the idea of actual versus forecast. Same thing on cash flow. If you make a forecast of your cash flow in January, you had $5,000 there. Your cash receipts were $12,000. This is your forecast now. You're expecting $28,000 coming in, and you're expecting to pay $22,500 out. And you're expecting to increase your cash from $5,000 to $5,500 that month, okay? When the actual numbers come in, again, you start with $5,000. Your receipts are lower at $25,000, and your cash paid out is slightly higher. So you end up at $2,000, okay? So of the $3,500 variance that we call, most of it is coming from the revenue side, okay? That we collected less, $3,000 less than what we expected, okay? And again, this could be lower sales, or our customers didn't pay their bills, so we need to make phone calls to them to make sure that we collect the money that they owe us. So our we don't have the similar problem next month, okay? So again, in an ongoing business, take the trouble to make a forecast for the following year, and then use your financial statements to see how your business is doing, okay? And the idea is to find out which areas of your business are not working as you thought, and you need to take corrective action to get back on track, okay? So that's the comparative actual versus forecast. See what else I got. Okay, so again, I have a couple more slides left, but I see there are some questions and chats. So I'll take a break and help Laura tell me what the questions are. Laura?
Okay, so the first question is, when manually keeping records, what needs to be recorded?
Okay. All right, when you're manually keeping record, okay, so again, in a business, I call them transactions, okay? When somebody pays you money, it's like, again, record, let's say you're doing it for a month, okay? And at the end of the day, you're doing it on paper or doing it on a spreadsheet, put that date down, and that date, if you got any checks or if you got any payments in your account, record. I call them revenues, record that, okay? Then below, if you spend some money that day on different things, you bought some supplies or you paid an insurance bill, record that, okay? So any transaction which brings you money or takes money out of your checking account, you're recording, okay? And if you put the date, the next day you do the same thing, okay? That some money came in, there'll be some days when nothing comes in and everything goes out, so you record that, okay? So, and again, that's the reason I talked about if you're doing everything with your business checking account, you can just look at your statement at the end of the month to see, or actually, if it's an online account, you can look at it every day actually to see if it went through your checking account, you will see that it's being recorded in your checking account. But if you're doing it by paper, you have to take the trouble of putting it down on paper. Just make a column with the dates across the top, and revenues, and then your costs. I hope I answered your question.
Okay, next question. Wondering if you can give me a guideline as to when I should stop doing my own bookkeeping and taxes.
Okay, yeah. Okay, so this is what I tell my clients, and I'll tell you too. You are in business to make money with whatever your expertise is, okay? So like, if I use the example of a pizza shop, your business is making pizza, marketing your pizza, selling your pizza, okay? Now, in the beginning, you won't have enough money, so you have to do your own bookkeeping, and your transactions are few. You can manage that, okay? As soon as you find that the time you're spending on bookkeeping is getting irritating to you and you have little money, as soon as possible, get a CPA, have them do your bookkeeping for you, or have them or have a software that is for you, because now you have money to get these tools, okay? In the beginning, a lot of my clients really don't have money to spend on anything extra, okay? On taxes, if you can get a CPA firm specializing in small taxes, and get them now. They'll cost you, in some cases, my clients, at least the first couple of years, especially if they have an LLC, they use TurboTax or something to do their taxes, okay? And the TurboTax guides them through that, okay? But many of my clients don't feel, which I say, comfortable. And so I tell them to get a small business, a CPA firm, a small business accountant, and start working with them once a year on them doing their taxes, okay? So general guideline is, when you don't have money, you have to do it yourself. And as we have a little money, go do it either with the software or with somebody. So you're spending your time, hiring people to make your pizza, marketing your pizza, expanding your pizza shop, things like that, okay? Because your accounting is being taken care of by some other people, okay? So that's the guidance I give to people.
Okay, and then next back to the consulting company.
Mhm.
For a consulting company, instead of unit volume and price per unit, would you look at project or client volume and price per project?
Yeah, I'm gonna ask this lady for a little clarification so I can help her. If you're able to just tell me what kind of a consulting you're doing.
Oh, let's see, Rebecca, I'm just gonna unmute. There you are. I'm gonna unmute you, Rebecca, so you can just talk.
Hi, I do fundraising. I advise primarily nonprofits on how to
Mhm.
access philanthropic support for their mission.
Okay. All right. So so essentially as a consultant, you are, I will say, selling your time, okay? All right. And so there are two ways you can go about doing this, okay? And I've used consultants in the past, so this is how the consultants that I worked with did it for me. So when you approach a nonprofit and they want to raise money, there are different things that. So first call, what is called is a scope of consulting. Okay, so in your case, you may be first finding them appropriate sources that they could apply for grants for, and then you may be writing grants for them. Okay, or not writing grants for them. I don't know. Okay, but so again, this is a project scope that you write down, and then for the people you're consulting with, they need to know, how much are they in the hook for, as they're hiring you. I would use a consulting rate, and I don't know if this is the right rate, but let's say it's $100 an hour, okay, of your time, and you put that rate down, and say that based on the scope that you are selling, let's say the whole project is 20 hours, okay, and you will bill them every week on how many hours you use on the company, okay. So if it's a 20-hour project and you're doing this over 3 weeks, your expectation is that at the end of the week you will tell them how many hours you spent, and you'll give them an invoice for hours times $100, okay. So that, and they're expected to pay that to you in some reasonable time frame, okay. Because obviously you have to eat and pay your rent too, okay. So I would in a scope, I would set up a rate, but I would also give them an estimated time of how much it would take. And the point being is this, that if you set 20 hours, when it reaches 18 or 19, you alert them that, hey, it's going to take more. And they have the option either to say, after 20 hours, we are done, and, we don't want to do business with you. Or they can say, no, we like what we're doing with you. And then you send them another scope, okay? And if you are working with some company regular basis, you can then have a sort of a contract, say, I'm going to give you so many hours a month at this rate. Did that help you?
That's awesome. And you think it's better to bill weekly rather?
Okay, here's the thing, Rebecca, okay? Okay, so let me just kind of think this through, okay? Yeah, in your case, I think you should bill weekly because you eat weekly, okay? And
Okay,
okay.
fair.
Okay. And I mean, but I'm going to just tell you to be realistic, especially if you're starting out. Some of these nonprofits are not too well organized, okay? So if they wait a week, you bill them, then they see how they pay you, and you can use your judgment They take a week or two. They know that you have done that. Okay. I at SCORE use a marketing consultant, a social media consultant. Okay, and we like her. She likes us, and honestly, she signs an yearly contract with us. Okay, and she, based on what we have negotiated, we pay the whole 12 months to her right up front. Okay, so
Oh, so you're paying a retainer fee.
yeah, we just say, we like you. We want to work. We want you to do these things, and her way of working. And she's in great demand, by the way. Okay,
Right.
so she's a social media consultant. She's a one person company, and we are sensible to her needs, and we want her to think of us as a good client. And we have the funds, and we say, hey, we're going to pay you each month everywhere, but we'll just pay you right up front, and then you want a retainer. Okay, so you got to work with your clients depending how much money they have. If they are also raising money, I mean, obviously you're in this money raising business. So the way I see your job is you set up some systems, you find out about the organization, which is like you're doing investment initially, and then you, depending on what they are, say, yeah, okay, please go ahead and contact these funding companies and make the grant request. Is that how that's working for you, Rebecca?
Yes, but I also secure funding support from high net worth individuals as
Okay,
well as foundations or corporate giving programs.
Okay. So in your high net worth individual program or effort, I think you should, based on your experience, it'll take a little bit of effort to research who these people are. And then, these high net worth individuals are not easy to get hold of. Okay. And you contact them and you recontact them, you call them, they ignore you, and then somebody makes a contact. Okay. So what I'm saying is you're using your time to be able to reach a point where you can make your pitch. Okay. All right. And hopefully the person says, yeah, I like that cause. I'm interested. And then you say, okay, I'm going to submit a proposal to you. So then you write this proposal up saying, this is what this nonprofit does. It helps parents of kids who have severe illnesses or whatever, and this is the records. Then you make your pitch to them. Okay, so you are investing your time in making the contact and submitting a proposal, and then that time should be billed at a rate that is competitive and acceptable to you.
Okay, thank you very much.
Any other questions?
No, thank you.
Okay. All right. So I have a couple more slides, I think. Okay. So how to start. Okay. And again, I think some of the stuff I've already said, but I'll repeat it. So have a business checking account in addition to your personal account. Run all your sales expenses through your business checking account. Do not commingle. You'll be confused. And more importantly, the IRS will be mad. So don't do that. Okay. Then analyze your monthly business checking account. Many banks now offer software that you can click on, and if you set up those accounts properly, you can at least start there to see how your business is doing. Okay. We talked about how to analyze pen and paper with calculator, personal software like Excel, Numbers or Mint, and then small business software like QuickBooks, Online, Xero, Wave, etc. Now, a lady who's talking about QuickBooks. So we have QuickBooks seminars at SCORE, and please research them on our website to see when the next one is. They are quite popular. And usually they're taught by some person from a CPA firm who knows about QuickBooks, and they are using that as an angle to get new clients. Okay. The other source of learning on QuickBooks is when you get your CPA firm, see if they'll help you understand enough of QuickBooks or any other software, because these companies, they have people in them, and they sometimes volunteer for SCORE to give a course, but they should also be able to give you some sort of a seminar to kind of guide you to use the software that you're using to run your business, and then comes time for taxes, they can look at that to file your taxes. Okay, so contact them too. Okay. Also, the software company like QuickBooks, I know QuickBooks now has a online version, and I think they have people who help you get set up and things like that and answer your questions. So use all those sources when you get in the software thing. And again, be patient. It's new to you. Setting up accounts is not that easy, but once you get it going, you'll be okay. All right. So use all the help you can get. Okay. And the problem sometimes is that people can't set up accounts, then the software doesn't work as it's designed. So that's frustrating too. Okay. Yeah. Yeah, very important. Keep, like I said, finances is like a foreign language. Keep learning with live or recorded webinars, scored mentors, accountants. Keep an interest on topics, financial topics. Talk to other business people. If some word sounds foreign to you, ask somebody or Google it. But again, there's a lot of information available on financial literacy. Use all the resources at the time you have. Okay. All right. And again, like the conclusion, starts with planning. When you're, manage your cash properly. When you're out of cash, you're out of business. People let their inventories build, and then they're out of cash. Remember, high inventory means you're investing your cash and it's not doing anything for you. So to keep the inventory turning, even if you have to discount it. Okay. Keep good records. If you're looking for a loan, banks look for 5 C's: capacity, capital, credit, collateral, and character. That's how they do to give their loans. And select an accountant that specializes in small business. Build and use meaningful statements. I already talked about QuickBooks. And work with a bank or a financing source that understands you. And also seek advice, use core resources, and then so that's the keep learning. Okay. And again, all our scores, mentoring services, workshops are free. And the reason we can do this is because I, like my 42 other volunteers at Akron SCORE, we all volunteer our time and some of the expenses that we do on marketing and administration. We have foundations in our area who are very, we are very grateful for the support. They give us financial support. The Calhoun Foundation, Akron Community Foundation, Welty Foundation, because like us, they believe in making small businesses viable. Okay, so we also thank them for their support. So with that, the presentation is over, and I see there's some more chats there, Laura.
Oh, we have some people just saying thank you. Somebody said that they're gonna go back to day 1 and work on spreadsheets.
Okay.
Yeah.
Yeah. Like I said, if you don't want to buy Excel, go if you have a Gmail account, find a way to get to Google Sheets, and it's great software. You can share those sheets, and I use it with many of my clients, and again, it's free. So it's free is always good. Okay.
Free is always good. All right, everybody, I'm going to send out that email later today with the slides from this, as well as a link to the recording, so you can rewatch it. And then, excuse me, check again at our website for all the rest of the workshops that are available locally and regionally and nationally. And that's all.
Okay, Laura, I'm going to send you this presentation. You can send it out. Okay. And Laura, thanks for your help. And thank you, everybody.
Problem. Thanks, everybody.